A big market voice, Prateek Agrawal, MD and CEO of Motilal Oswal Asset Management Company, Johnson, on the show today. Prateek, so good talking to you today. At the outset, a very happy news somewhat. Unfortunately, it's not
Happy New
quite
Year.
starting off in a good note, Prateek. Before we talk about the long-term, Prateek, what's the cause for the concern today? We heard talk of some margin calls getting triggered, some other reasons, but it's come as a surprise to a lot of people, the ferocity of the down move today.
Yeah, so that's been a surprise to us as well. Maybe to some extent, the motor trading, the spaces which were buoyant are correcting, so that happens on a lower volume and more domestic participation versus institutional. So some bit of that may be happening today. But yes, the sharp downtick was not expected. What one also needs to look at is arbitrage funds and their ability to keep absorbing large blocks, especially in the space where F&O exists. If the arbitrage yields fall, the attractiveness of that space versus the usual debt funds reduce, and that can impact the ability to absorb large blocks also. So maybe some bit of that also happening.
Wow, okay. You reckon that could, okay. Prateek, you reckon that could also be a technical factor. Now, if that is indeed the case, would that be long-lived or would it be a fairly swift corrective move because of, I mean, essentially the arbitrage funds led piece that you spoke about?
No, so when the selling pressure is high, the premiums reduce. If the premiums reduce, arbitrage returns would fall, and that will cause that space to be less attractive versus let's say a liquid fund or an ultra short-term fund, and that sets in its own dynamics. It can change very quickly if there is some positivity and we get a day or two of market up move and the premiums get restored. So that is how it is. Now, arbitrage used to be a not so large space, but now two funds together maybe a lakh crore with rest of the funds also of a reasonable size, though smaller. But we have got two very large funds.
Prateek, hi, good afternoon. Tamanna here. I'm just wondering what the strategy right now is. Are you sitting on the sidelines waiting for a further fall? Is this the time to start deploying cash or wait?
No, so we as a house typically stay almost fully invested. I keep saying this. We are focused high conviction house. Our single position is minimum 2.5% by design, which means 2 to 3% cash is one position cash. So enable trade, we may have that kind of cash, but that's about it. So we stay fully deployed. We are currently fully deployed, but we are deployed in spaces where we see earnings growth trajectory to be very high, not for 1 quarter, but for 2 to 3 years, a large delta over index. Our belief is over time, market follows earnings growth, and I think that is the source of outperformance. So we are not there in many spaces. So this result season hasn't been too good, especially for index-heavy spaces. Well, we are not there.
What would you look at? Anything that you think is now at the right valuations? I mean, if you look at some of your banking majors have taken quite a tumble, especially in the private bank space. Anything there which is now beginning to look attractive, Prateek?
So I have a differing view there. In any economy, when the economy is being tested, it is just the start of a emerging market kind of a phase. Banks are the easiest way for foreigners to enter into a country, and one finds bank as a part of total market cap, bank as a part of index, increasing over a period of time and then peaking out. to have an index which used to be 35-36% lenders, can it get higher than that? Okay, is point one. As the economy diversifies, as people have other sources of capital, private equity markets, etc. Banks don't remain the same commanding position that they used to have, and that should be reflected in their position in the index as well. Second is valuations itself. Now, just look at it. We have some cases where the market caps may be 2x the lending book. Think of it. Market caps are 2x the lending book. So you lend $100, your market cap increases by 200. Is that sustainable? It does prompt you to think. So while a lot of people would say, on P's they look cheap and etc. Maybe banks are just simply making too much of money, and over time, with so many of them doing practically the same thing, competitive intensity should result in lower margins. But whatever it is, our view on banks is a tad different from that of the street. So our funds are actually reasonably low on banks, and that's worked for us. Maybe a quarter hence, maybe 2 quarters hence, when the NIM pressure reduces and we start to see them deliver earnings growth in excess of the index earnings growth, we would up the banking exposure. But as yet, we are below 10% in most funds.
Prateek, one follow-up. There are murmurs of the index hitting levels of 22,000 as well, and not surprising people. This was not in the realms of conversation when we were at 26,200 just about 40 days ago. So now, one, could it be possible? And anything is possible, of course, but do you believe it's realistic? And what could be the factor? Would it be the earnings-led disappointments thus far, or is it something else if indeed we are headed there?
No, so one, I don't believe we are headed there. Two, I think the market has digested most of the difficult news, difficult phase that was presented before it. So, the result season, everybody knew monsoons are very good. If the monsoons are very good, we tend to work a tad lower. For example, coal would be mined a tad lower. Etc. So there is a small slowdown in economic activity. Now, post monsoon, the reverse happens. You get a good crop. The farm incomes go up. There is cheer all around. So it is one phase to the next. Then in first quarter, you got general elections. Obviously, government spending did not happen. We looked at government balances with RBI high and liquidity in the system being low. Now you have seen the deficit figures in the first half well under control, which means in the second half government spending should also increase. Third, you were looking at very large NFOs, IPOs, QIP kind of a supply of paper. Now, some of the largest are behind. One or two are left. That's about it. So, one more source of investing, which was probably reducing the flow to the secondary market, would also be out of the window. So many things which impacted market sentiment over the past 2 quarters are now behind us. Yes, one new thing has emerged, which is US bond yields moving up and sharply. So just a month back, there was cheer. They had cut rates by 50 bips. Bond yields had come down to 3.75. And people thought there would be more cuts, and we will get even lower. But now, as we speak, they are at 4.3 in the US, and that is what is causing a lot of money outflow from the country into probably back into the US. So I think that is something that we need to look at. As we see bond yields there stabilizing, I think the selling pressure here should also stabilize. That said, we do believe the bulk of the selling pressure, the in terms of intensity, is probably behind us. We can't be getting 7,000-8,000 crore a day kind of outflows. I think if 3,000 to 4,000 crores a day kind of outflows happen, it should prove to be way more sustainable.
Okay. Thank you so much, Prateek, for joining us. It's a tough afternoon, but we'll have to wait and see what the next few days are looking like. Mainly, OMC and gas stocks also in focus. They are sinking in trade. Mihika joining us now with what the key triggers are for the fall. Yes, Mihika.
You have the Nifty oil and gas down about 3.8% intraday. When you talk about the top losers, you have companies like IOCL, BPCL, HPCL, and Reliance Industries. And the Indian oil marketing companies have fallen over 4% intraday. Now, when you talk about what's not working for the OMCs, well, up first is the volatility in Brent prices. While they do stand lower on a one-year basis, they have seen almost a 4% uptick in the past week itself. And the OMCs also posted a weak Q2 earnings. They have extended LPG losses. Now, they did announce a commercial price hike by 62 rupees for the 19 kg cylinder. However, when you talk about, while this could offer some relief on the LPG losses that the companies have been facing, they have been facing majorly losses on the retail part of it, which is currently played on a subsidized race. So the market's not, you can see while this would be positive for the realizations, the stocks have corrected. When you talk about what's not working for Oil India and ONGC, well, production outlook remains uncertain. The companies are yet to post their Q2 results. And lastly, when you look at the city gas company pack, well, IGL, MGL, GGL all fallen 2 to 4% on an intraday basis. One of the major headwinds for the sector is the lower APM gas allocation, which impacts their operating costs and thereby their profitability. Analysts also expect near-term margins to remain under pressure, and the PNGRB notice to end network exclusivity is also a key overhang.
Okay, well, that's OMCs for you, though. It's pointless singling out any one bucket because everything is done really, really badly. The only contrast is, interestingly, that two-wheelers are down under pressure today, and we have a four-wheeler name in Mahindra & Mahindra right at the top of the pile when it comes to the Nifty 50 gainers.